How do you do, ladies and gentlemen? I'm your host, Seth Julian, welcoming you to tonight's session titled Risk and Money Management. For those of you who are new to the business and or have experience and you've lost money and you want to get a handle on that, this is the place for you. It's going to be a little involved tonight. There's no real live trading or anything like that. It's this is a backgrounder, but it's this is hardcore. This is for people who are a little more serious. If you're the type of trader who just likes to have a good time and place a little money now and then, see how it goes, win a little, lose a little, I doubt that this session is for you. If, on the other hand, you want to become a little more proficient and long lasting, and not and make more money than you lose in essence, then this is the session for you. Let me ask you, before we get too far into the program, to acknowledge whether you can hear my voice and see the opening screen, and then I'll be able to begin in full confidence. Just say hello, just let me know that you can hear me. I know that John mentioned that he can't hear me, but oh, hi, Elias, good to see you again. Muhammad, very nice to see you all. Beautiful. Everybody says all good, says Chris. Excellent, great, okay. Wow, it's a big crowd in here today. Excellent. Excellent. Okay, great. So I expect a lot of interaction from you people. I hope I don't, cause any unnecessary comas. Anybody slips into. I see Lucy. So great to see you all. Lots of friendly, familiar faces and names in the room. All right, so let me introduce myself particularly tonight by saying to you this. First of all, I'm 64 years old. I've been trading for 51 years in the capital market. I started out as a young man with a gift of a few shares of a stock that's Signal and still is. Its symbol is XRX. Xerox at the time I was a young man was the Apple and Google of its time, and I've been trading ever since. But I want to focus specifically on the subject of risk and money management. I have lost my trading account 3 times in my career, twice with quite sizable sums of money, I might add, until I figured out the game. And there's a lot of aspects to it. And anybody who's here thinking that this is a get rich quick scheme, that you don't have to put your time in, that all those nonsensical stories you read on the internet of literally getting rich quick, those are for the birds. Those are for people who are just gullible and lazy. This is a business like any other business. You have to put your time in, you have to do your homework, and you have to be prepared. And you also have to learn. Many times, in fact, almost entirely the hard way. Nobody comes across this easily. Nobody is born a success at this business because it's not because the challenge is not intellectual. The challenge is emotional. And um, and again, I say all this by way of hi, Joyful. Good to see you. Good evening to you too. I say this by way of introduction because what we're going to talk about tonight is I'm afraid to say is fairly dry material. It's not exciting or interesting. It's not the excitement of what's happening in the commodities markets as a result of the war in Europe or anything like that. This is nuts and bolts um, trading mechanics. It's risk and money management. And but I must tell you, in all sincerity, and despite the fact that this may be a little heavy slogging tonight, this is the key. This game is not so hard to understand. I can tell you all you need to know about trading in one sentence: buy low, sell high, buy low. That's all you need to know. You think the price is good. If the price is moving up, you buy it low. When the price moves up higher, you sell it higher than you bought it, and there's your profit. The price is falling, you sell it before you buy it, which is possible given in the derivatives market, as well as the futures market, as well as the stock market, as well as many markets. And you buy it back when you close the position for less than you sold it. That difference is, again, your profit. It's the same thing. Buy low, sell high, buy low. That's the whole Torah, as they say, as the Jews like to say. That's all there is to it. So any child can grasp that. It's not hard. I'll tell you what's hard. What's hard is controlling yourself when you're in a position, even taking the good case, when you're making money. Greed overcomes you, and greed is a very, very powerful emotion, and it blinds you. It handicaps your ability to think clearly. You become greedy, and those of you who have been in this position, and I know there many of you have. I certainly have been in every time I trade. You get in, you start to make money. You can easily get blinded. Well, wow, this is a nice trade. I'm making money. I can. You think you take your spouse out to a nice dinner. You show them how intelligent you are, how much money you made, and then again, then you start to really make some money. You say, well, I'm gonna get that Rolex watch I've been looking at, and then you really start to make money. You start thinking about a second car or a home, or you get the idea. And as you're fantasizing, the position starts to go against you, and you simply give it back. Well, I didn't really need a second house. Who needs a boat? I can do without a new Rolex. I don't really have a nice watch, et cetera, et cetera, et cetera, until you either break even or lose. And that's the good case. In the bad case, you enter a position and immediately turns into a loss. And then what do you do? Well, you don't want to say I was wrong. Your ego gets in the way. You become fearful, frightened. Your money is vaporizing before your eyes, and you become fearful. Fear is a more powerful emotional motivator than greed. But whatever it is, it clouds your ability to think straight. You often hear the expression of a deer caught in the headlights. What does that mean? The deer obviously knows how to run. The deer is a gifted runner. It can escape practically all of its predatory enemies. But when fear overcomes it because of the oncoming headlights, roadkill. And I didn't intend to use that metaphor thusly, but our accounts then become roadkill. We lose all our money because we just couldn't get out of a trade. We watched it got bad. We rationalized it. It would come back. It might come back. It should come back. I'm ahead of the market. I'm early. The market doesn't know. I'm late. Anyway, whatever it is, wrong. We were wrong. We lose the money. So what we're going to talk about tonight are methods, tried and true methods to overcome this dilemma. So let's start with a quote from Sun Tzu, the famous medieval Chinese general, who is pretty much understood to be the granddaddy of military strategy. I think he wrote that. Did I say medieval? I believe he wrote it in the early part of the Common Era, around 200, 300 of the Common Era. So it goes back a long way. Planning your trades. Chinese military general Sun Tzu famously said, "Every battle is won before it's fought." The phrase implies that planning and strategy, not the battles, win wars. Similarly, successful traders commonly quote the phrase, "Plan the trade, trade the plan." Just like in war, planning ahead can often mean the difference between success and failure. I would just remove the word can often, take out often. It's entirely the difference between success and failure. By the way, ladies and gentlemen, I forgot to mention in my introduction, which is a little bit off the beaten path tonight. Please feel free to ask questions during the discussion. Okay, it leads to a more of a dialogue rather than a coma-inducing monologue, which I'm always afraid of doing. But please feel free to ask questions. It's really it's respected. We don't want anybody to feel intimidated or inhibited by in any way. We respect the act of questioning. It's a sign of commitment to the process. So don't feel that there are any dumb questions. Okay. All right. So and if I don't answer them, in real time, we'll get to them. We'll get to them before we end the broadcast. And if they're not germane, I'll have my step now. Risk and reward. And I'm going to go through this quickly because it's just text. It's not interesting pictures in this presentation. It's as I say, it's dry, but it's crucial. It's important. I really don't want to undersell this. Successful trading is very much about getting the balance right between risk and reward. And how do you do that? And that's a simple thing. It's not so complicated. All you say is, I'm going to put $1,000 at risk on this trade. And so the position will be for 1,000. I'd like to make 200. These are completely arbitrary numbers. I'd like to make 200, and I'm prepared to lose 50 for the 200. That's what is that? A 3-to-1, 4-to-1 risk reward ratio. That's all there is to it. I just did the calculation. I didn't even take out my calculator. You figure the amount of and we'll talk about how you figure the amount. The amount of the initial trade is often just based on the account size. There's the old 2% rule, which is common. As your account grows bigger, you'll find that rule actually gets smaller. You don't risk more, and as your account gets smaller, and if you have a smaller account, unfortunately, people tend to take larger positions, which is unfortunate, but it's natural because oftentimes there are minimum sizes to these positions. You can't trade $5, $2, $3. It's not the neighborhood betting shack. But so whatever that amount of trade is, you say to yourself, how much am I prepared to lose versus how much am I prepared to make? And I say it in a very particular order. You first deal with the amount you want to lose. Professionals, or I should say amateurs, think about how much profit they're gonna make. Professionals think about how much money they can lose. So the order I say these things in comes from years and years of experience trading. First, you figure out, okay, at the position size, I'm going to put $1,000 on this. Something close. It depends on what the asset is. Sometimes you can't get exactly 1,000. It's not a round number. 1,200, 1,100, 900, whatever it is. And then you figure, okay, how much am I prepared to lose in this position? Now, what that particular calculation is a little more complex in that it depends on the volatility of the asset. And we'll get to this in a moment. I'm getting ahead of myself. But what I'm trying to tell you is, first and foremost, is there a connection issue? Audio is breaking up, says Eduardo. Nope, not that I'm aware of. Anybody else have any problems? By the way, the session is being recorded, and you'll all receive a link to the recording in a matter of hours after the conclusion. So, okay, Mohammed says no problem, Eduardo. Your voice gets choppy at times, Elias says. Yes, I know that because I speak too damn fast. I'm sorry for that. So getting the balance right between risk and reward, more returns are normally accompanied with higher risk, along with reduced likelihood of success, okay? I want you to keep that continuum clear. When you are prepared to take larger losses, you should be prepared. You obviously are prepared to take, looking for larger gains. Nobody risks, if the position is 1,000 and you're willing to lose 500, nobody's going to get out of a trade that they're, when they made $50, if they're prepared to lose 500. That's lame. And sooner or later, you'll lose all your money. Nobody acts like that. So when you're, and vice versa, if you're not prepared to lose that much money, and many prudent and experienced and wealthy traders are not, excuse me, then you're going to earn your profits more slowly, but they'll be more steady. Okay, that is a crucial thing that took me years to understand. You make your money two ways: quickly, and therefore have a very high risk of losing it quickly, or you make your money slowly and have a very low risk of losing it quickly. You choose. This is and again, this is why I say this is a highly personal game. You have got to control these demons yourself. These are the demons that operate within each and every one of us, regardless of how educated or smart or sophisticated or experienced we are. We have to control these demons. And all successful traders do. And virtually all unsuccessful traders do not. A successful trader will only go for the riskier trade when they have conviction that their trade is a winning trade. We talk about this in other, thank you, Joyful, in other contexts. How do you enter? What are your entries? What are your exits? We talk about this in many different contexts. We're not going to go into it now. But it's achieved by putting in the effort on the research and analysis behind every trade. The best strategy is diversifying your portfolio. You should go for a mix of trades. And we'll talk about this later when we talk about the correlated trades and risk of correlation loss. Making sure you're not overexposed to a market's movements. In other words, if you're long euro dollar, you don't also want to be long dollar yen. All of you want to keep you diversified. And diversification is just a fancy ass word for fewer eggs in more baskets. That's the essence of all risk management, by the way. I can reduce risk management to that one statement. Fewer eggs in more baskets. That's the essence of risk management. Spread it around. Don't concentrate your risk. Make sure your risk is spread around. Buying gold and silver in the euro. If the price of the dollar goes up, there's an increased statistical likelihood that the price of gold, silver, and the euro will fall, leaving you overexposed to one market's fluctuation in price. Manage your risk, limit your losses. A key consideration for traders is risk management. The CFD, which is what we offer here at the house. I didn't mention this actually in the intro, which I usually do. We don't trade the underlying. We trade a derivative based on the underlying. Most of the world's capital market trading is derivative based. In fact, something on the order of magnitude of about 5 to 1. I think the amount of oil that's traded in derivatives is outnumbers the actual underlying oil by something like that, 5, 6 to 1. So much more takes, and there's a reason for that. They're much more flexible, they're much more affordable, they're safer, they're they've got a lot of advantage to them that the underlyings don't. So, but and one of them is the ability to trade partial or fractional parts. They're very flexible, and it makes managing your risk much easier. It's hard to, well, I won't go into the details of it, but suffice to say that CFDs are terrific assets to trade, and their prices are entirely based on the underlying asset. So it's not like we're trading a different asset; it's just a different form. Now, you can never lose more money than you've invested. Whilst there is no trading strategy that does not encompass some form of risk, there are a number of methods that an investor can make use of to minimize the financial exposure they have when taking a trade. This is how risk management works. Okay, the first part is limiting your trade. This is an important part of risk management, often gets overlooked. Normally because someone is trying hard to recoup losses or becomes greedy with the investment stake. Making successive bad trades can exhaust funds. Therefore, it is wise for a trader to apply limits to the amounts on single trades. And again, we talked about this. I talked about this earlier in the intro, to around 5 to 10%, the 5 to 10% mark. As your account grows, you want to limit it to the lower end, 5 or lower. Over the years, my account has grown sufficiently, and I've taken up enough profits to know I don't need such big trades. And this is also, let me digress here for a moment and just talk about the adrenaline flow. Now, again, I'm not talking to people who are here for a thrill, and I don't disparage people who are here for a thrill either, by the way. Lots of people trade. My brother is he's an accountant by training and by profession, but he likes to get involved in the markets now and then. He sort of actually likes the thrill of the excitement of a loss or a gain. He trades oil contracts once in a while. And he has his own sort of internal risk management things, but it's not what it's about with him. If you're here for that, fine. By all means, you're welcome. We make a living from commissions from traders like that as well. But for those of you who are a little more inclined to become long-term, regularly profitable traders, you're gonna have to deal with this. Actually, it's a what's the word I'm looking for? And it's an anomaly between trading and the adrenaline rush. What I mean by this is that we all know that there's a big rush when you trade, and when you put that money in the market, whether you lose or win, you feel that adrenaline. That's a very, very powerful. I think adrenaline's a hormone, or it's a psychoactive chemical that the brain produces generally under stress, or excitement. In both cases, norepinephrine, dopamine. I'm not a neurochemical expert, of course, but I certainly have experienced the effects of these chemicals. You've got to control them. You've got to say to yourself, I'm not here for that rush. If you are here for that rush, as I say, by all means, you're welcome. But I'm not talking to the people who are. I'm talking to people who feel that rush gets in their way and causes them losses. Because for most of us, that's exactly what it does. You're going to have to face the fact that you want to. One of the ways of limiting it is limiting the size of the trade. That's all there is to it. And I'm not. And if you're not an old, grizzled veteran like me, and you're just starting out, the same advice holds. Keep your trades, limit your trades. A figure that gets bandied around is the 8.5% figure. This means a trader that will have at least 11 bad trades before they lose all their money, and actually they will receive more than that due to the percentage of staying constant. This means that the staked amount lowers with each trade. So if you are willing to only place 8.5% of your account in any given trade, you'll have at least 11 bad trades before you lose all your money. Now, if you make 11 bad trades in a row, you obviously you have other problems. But at least trading that smaller amount will keep your ammunition dry for longer. That's the whole point of this. Again, I want to emphasize it's very important for me that you understand it's not complicated. This is third grade math. All right, all the math you need to be a successful trader you learn by the time you're in the sixth grade. I promise you. I have a fancy calculator I use once in a while for analysis, just because I'm lazy. But the math in this business is fairly straightforward. It's simple. Big advantage of placing a set percentage of the total funds is that the amount risked on each trade will get gradually less and less if you are on a losing run. This is important. Many books and traders will refer to the fact that when they're on a run, a successful run, they up their trade size. And when they're on a losing run, they down their trade size. I firmly believe in that. I don't really, believe in karma or things like this, but I am experienced enough to know that there are factors involved when you win and when you lose, and you have to pay attention to your actual whether you're winning or losing. And while that may sound trivial, you'd be surprised at how many traders, particularly the losers, don't even bother paying attention to whether they're on a winning streak or a losing streak. So, and that gets into the subject of journalizing, which we're not going to talk about tonight, but it's an important part of risk management, in my opinion. Simply record keeping. Keeping a record. If you look at how you're feeling, what you ate, whether you had a spat with your spouse, whether your boss is making you crazy, whatever it is, you want to be able to collect this data so you can actually start to analyze it and correlate what's happening when you're winning, what's happening when you're losing. Big advantage of placing a set percentage of the funds is the amount risked in each trade gradually unless you're on a losing run. Thus, the value of each loss will be reduced. Conversely, if you are on a winning streak, your total fund is increasing. The amount each stake will increase, and you will maximize your returns. Prudent to withdraw money that is superfluous to trading requirements, as profit only becomes profit once it's banked. You got to remind yourself that you're playing with cash. This business is about cash. If you don't take your profits out now and then and put them in the bank, or buy a gift for your loved one, or invest in your children's education, whatever you choose to do with your funds, you will lose sight of the fact that you're in this business to take money out of the market. That's what traders do. We're here to take money out of the market. So if you're only trading a small percentage of your account anyway, take some profit out and put it away. Do something else. Invest something for the long run, but take profits out occasionally. Protect your money. One method to protect your capital when you find yourself in a losing streak is simply to cease trading until the market conditions turn around and begin to move in a direction more agreeable to your strategy. I cannot really emphasize this one. Most of the time, the most intelligent thing you can do is sit on your hands, do nothing. Now that may sound remarkable, but it isn't. One of the most intelligent things a trader can do, somebody who on a regular basis engages risk, looks it right in the face, right between the eyes, and says, "Bring it on." One of the best things you can do is just say, "Pass. I pass. I don't understand the market. It's not doing anything that appeals to me. I don't get it. Why get involved? Don't trade for the sake of trading." Again, and I address this to people who I hear to attempt to take more money consistently out of the market over the long run. And I keep emphasizing that because, again, I do not disparage people who don't have that predilection. You're certainly welcome in the house. If you don't, lots of people don't. They enjoy it. They're here for a punt, as the British like to say. They're here for take a position, have some fun. Fine, by all means. But if you're here to up your game, as it will, you'll pardon me for the. I don't mean to disparage. You're going to have to face the fact that you don't understand all the time. I don't understand all the time. When I don't understand something, I don't take a trade. If I'm in the NFP and then the report is positive and it should be strong, and yet the market reacts another way, I don't follow the market. I sit on my hands. If I don't understand it, I'm not interested. It's far wiser to carry on trading with reduced investment amounts so that you are still in the hunt and can know a lot when the trends are turning, a lot better when the trends are turning, seeing the improvements when it occurs. In other words, don't trade unless you can understand where and why things are moving. In effect, a number of small trades may more often than not, may be more profitable over one larger trade, as it's not an all or nothing scenario. It's not necessary for all your trades to win to end in the money, whilst a single larger trade offers only one chance. Make money slowly. I liken this business to the regulars in the room. You've heard me use this expression. This business is like picking up nickels in front of a steamroller. What the hell does that mean? Say what it means. It means you bend over and you quickly take your money and you get in and you get out, and you get in and you get out, and you make a nickel and you get out. Stay there and try to make a pile of money with each trade. That steamroller is going to crush you to death. And that metaphor is completely apt. Your trading account will be history. There are lots of people out there smarter than us, with way more resources than us, just waiting for us to be a stupid, greedy position so they can take that trade out, so that they can take the trade opposite ours and lose and win and watch us lose. Don't think it's everybody's equal in this market. They're not. There are lots of people out there. This is a zero-sum game, ladies and gentlemen. Every dollar I take out of this market comes out of somebody else's wallet. And every dollar I lose in this market goes into somebody else's wallet. It's cutthroat. It's competitive. So you want to make sure you understand at least what the hell you're doing with your money, so you have a fighting chance. Stay focused. It is essential that a trader stays focused on his or her strategy. And what does strategy mean? Let's digress a bit here too, because I want to again make clear this is not rocket science. We don't have a strategy to take over the European landmass in an invasion with generals and armies and air forces. No. Strategy simply means a plan. And don't be confused by thinking a plan requires a PhD in statistics or mathematics or economics. No, a plan just means what are you going to do when certain things occur. That's all it is. And that's all it should be. When the market goes up and I see that the price crosses above the 20-day moving average, I buy. When I see that the trade falls below the 20-day moving average, I sell. That's a plan. That's all there is to it. Do you need to be a PhD to write a plan like that? No. It's a reasonable plan. It's called it's a moving average strategy. Millions of traders use it and make money with it. It's a million. Again, the plans are simple. As I said in the opening statements, a child could recite what it takes to make money in this market: buy low, sell high, buy low. But you got a plan. Stick to the plan. If you've done a little bit of research, you've done a little bit of homework, you see that the plan over time is profitable. Stick to it. When you see that consistently the plan isn't profitable, leave it. Come up with another plan. But stick to the plan. Starting slow and scaling up don't make wild guesses when making a trade. Take it easy. Start slow. If the position is profitable, add to it. In other words, move the stop up or buy more or sell it out and then continue to buy. Take your profit up. Protect yourself. The research needs to be done, but at the same time, you have to anticipate losses as they will happen. When they do, you have to react. The reaction can be the key difference between success and failure in trading, which is why it is essential to stay focused on your well-thought-out strategy and not succumb to irrational emotional trades and getting greedy when you get on a winning streak. That ever happened to anybody? Happened to me plenty. You want to not only do you want to avoid that, you want to eliminate that. Now I want to talk about something that we mentioned earlier called a volatility-based stop loss. And this is something that really, really eludes most traders, most beginners anyway. Volatility stop loss simply means that if there's more, and just take a look at this. I'm gonna skip over the text because it is a little bit mind-numbing, but you can see here that the volatility here is low. This is euro dollar. These are different euro dollars at different times. It doesn't matter. They're arbitrary for the point of illustration. You see that the price movements are very, very much smaller here than they are here. So if this is I mentioned the exponential moving average crossover strategy. This is the entry point in both of these cases. Now, if it goes below this line here, I have to be able to say, well, I have to be able to absorb more loss in order to realize my gain, because it's likely just to move that much by virtue of the noise, by virtue of the volatility, which is a fancy way of saying random market movements, than I would in a trade like this. So I have to set my stop losses more further from my entry points. Therefore, my risk in these more volatile trades is larger, and therefore I ought to be taking a smaller position size. Is that complicated? No, it's not complicated at all. You've got to incorporate the volatility of the market you're trading in at the time to your risk and money management consideration. That's the whole point of volatility-based stop loss orders. The average true range, which is an indicator of volatility, will help you with that a little bit. I'm not a big believer in too many. My approach to indicators is the fewer the better, less is more. But in terms of if you can't visualize this volatility, the average true range indicator is a helpful device available on most charting programs. By the way, the charting program I use, which is here and all over the place, and to which I've had an account for many years, is TradingView, the Rolls-Royce trading service on the internet. The free version is more than adequate for most traders. I have a paid subscription because I have a few fancy indicators I've come to appreciate over the years that you have to pay a little extra for. But even at that, it's well worth the money. It's very affordable. It's the Rolls-Royce trading. So that's the idea of using volatility in determining your stop losses, so you don't set them too short and keep getting thrown out with losses that you should have been prepared to absorb in order to realize the profit, because you might have been right, but the stop losses tripped you up. Remember, getting stopped out of a trade by having a stop loss hit is no great honor. Yes, it does limit your losses, but remember, we're here to make money. So you want to be able not to be stopped out. You want to hit your profit target and then get out. Your profit stop hit, not your stop loss hit. You can see the dilemma. It's there's no dissonance. It's not a dissonantial problem, but you do have to set your stop loss sufficiently so that it will not be ticked out simply by virtue of volatility, and allow therefore the price to move in the direction you expect it to, and then have your take profit stop closure position. Maximum position of 2%. We've talked about this already. This is the position size. Not risking more than 2% the current account balance. This is more in line with, I realize this is in slight conflict with what I said before, 5 to 8, what have you. I prefer the smaller percentage. The table shows, I'm sorry, there was a table that I removed because it didn't make any sense. But the idea is that you take a smaller percentage of your trade and of your account rather, and trade that. Now, in the case where the volatility is higher, you've got to take an even smaller percentage because the volatility will stop you out. In other words, if the volatility is high, you're going to have a longer stop loss, which means that it might, if you take this your 2% of your account, the volatility alone might end up being greater than the 2% of your account. So you have to take a smaller position. That clear to everybody, ladies and gentlemen? Again, the mathematics is fairly straightforward. It's simple. Okay? And I do make reference here to the turtle traders. A guy named Dennis, how he trained traders to trade. It's worthwhile reading the turtle traders. And the turtle trading method is entirely based on volatility-based risk management. So you want to determine the stop loss distance first. Most amateur traders start by evaluating how many contracts they want to buy and then set their stop loss in order so they can achieve random risk goal. Never start by thinking how many contracts you want to buy or sell before you know your stop loss. And I made reference to this earlier, ladies. It's crucial. Professionals think about how much they're going to lose, how much they can lose. Amateurs think about how much profit they can make. Now, this again, this is, I think we're getting to the end here. We're talking about this is the correlation risk. Here we see that in the case, and there are two assets here on this chart. It's the euro dollar. What is it? There's euro dollar and there's something else here. I can't really see what it is. Doesn't matter. Here there are these are assets that move in the same direction, and these are assets that move in the opposite direction. So a positive correlation means that the two markets move in the same direction. Negative correlation means the opposite direction. They show two completely different scenarios. On the left, you see two price charts, the red and the blue, with a very high positive correlation. The two graphs almost move identically. And you'll see that in currencies. You'll often see that in identical metals. You certainly see it in the different crude blends, WTI, Brent, the Urals, unfortunately, or the Saudi sour, whatever. whatever they're correlated. They move in tandem. The two graphs on the right have a negative correlation. They move in opposite directions. So a trader who enters trades in the same direction, two buy or two sell trades in the same asset, on positively correlated markets, increases her risk because it's more likely that the two trades end up in the same position. You don't want to do that. That's silly. You want to be able to diversify. We mentioned this earlier, the concept of diversification. Again, what's the essence of risk management? Fewer eggs in more baskets. So that's the idea of correlation risk. And again, this is just a simple chart showing the if they're negatively correlated, trading in the same direction reduces risk. And if they're trading in the opposite direction, negative correlation increases risk. This is self-evident. I don't want to dwell on this. And vice versa. Positive correlation trading in the same direction has increased risk, and vice versa. We don't need to dwell on this. I think you have any questions about this, ladies and gentlemen? We'll skip all this. It's fairly self-evident. Adding to a winner. Now, this is something that professionals are well versed in. They often refer to it as scaling in. There are a number of different names for this, but the idea is that when you're in a winning position, increase it. You maximize your losses. Many traders will simply exit the position with the loss and enter it again, having thus secured their profit. So traders usually do not enter the full position size on the first entry. Remember that they use the 2% per trade rule, but they usually split their order across multiple entries and add to the winning position. Their first position, say, would be 0.5%. And after the trade is moved into profits, they would add another 0.5%. They keep adding to the trade until they reach the maximum of 2%. Is that clear to everybody? That's adding to a winner. And the advantages are fairly obvious. You limit your losses. The strategy is a breakout and trend following strategy. And a false breakout, which even the moving average crossover strategy, which is a really very basic strategy, has also false breakouts. When the price will immediately reversed, they usually have only a very small position and have not yet scaled in. Thus, the loss they take is only a small percentage of the 2% maximum risk. Clear, ladies and gentlemen? You can catch large winning trades and protect your position. You would only reach your full position during the high momentum breakouts. And once you've reached the maximum exposure of 2%, the initial loss orders would already have locked in some of the profit. Adjusting position size during losing streaks, this is the same consideration, but in the opposite direction. Most important thing during a losing streak is not how fast you can recoup your losses, but the degree to which you can limit your losses. I cannot emphasize that enough. Again, let me restate the well-worn Wall Street aphorism. Amateurs think about how much money they can make. Professionals think about how much money they can lose. Professionals are risk obsessed. That's why they're in the market successfully over the long run. The rule to limiting drawdowns during a losing streak is quite simple. Your account drops 10%, then you trade as if your account has lost 20%. You lost $10,000 on a $100,000 account, and you then trade as if your account has only $80,000 left. This means that even though your account is now $90,000 and your 2% rule would allow you to place $1,800 positions, you trade as if your account has 80 and therefore would have a maximum risk exposure of 1,600. This strategy will greatly reduce the losses once a trader enters a significant losing streak, and it takes away a lot of emotional pressure as well. Remember, I'll say this again. I've said this a million times. I say this every time I can, every time it's germane. This is an emotional business. The principles are painfully simple. It's about controlling your emotions, and that's what this session tonight is dedicated to. Tools and devices that are used to limit our emotional exposure to ourselves. We're all humans. We're all made up of the same emotional content, and profit and loss, risk and reward, fear and greed act on each and every one of us identically. We're all wired the same way. But the professionals understand better than the amateurs, and they learn to control those emotions. So let's just have a quick run through, and then we'll finish up. We'll open the floor to questions. Good risk management combines several elements. Inclusion of diversification, that's less eggs in more baskets. Clear agreement on the expectation of volatility and return. Maintenance of supportive relationships between investor and plan makers, yourself, your broker, your partner, your family, etc. And above all, stick to the system. And then the fourth rule is C3. Above all, stick to the system. The system tells you to get out at a certain point, you get out. Don't override your stop losses. Stick to the system. All right, ladies and gentlemen, that's going to conclude our formal part of the session tonight. Let's open up the floor to some questions. Anybody? Well, ladies and gentlemen, if I don't hear or see any questions, I will bring the session to an end. It's just about the time I like to end anyway. So just let me say, if you're thinking about questions, first of all, for our clients, we're always very humble and gratified that you have chosen Alvexo as your online trading brokerage. And for those of you who are interested in opening an account that come to us who are scouting out brokerages, please consider opening an account with us. We're straight shooting stand-up brokers. We do the best we can for our clients. We don't win all the time. We're not right all the time, but we do make more than we lose over the long run, and that, after all, is the sine qua non of this business. Benjamin asks, thank you very much for this information. Oh, wait, no, this is the first one before that. Lionel asks, how to have some diversification between the assets? Well, think of different classes, between classes, commodities versus bonds, Forex versus stocks, stock indexes versus commodity indexes, etc. Or even within groups, technology versus retail, arms manufacturer versus chip manufacturer, like that. Diversify, different. Diversity just means different. Minor. Benjamin asks, thank you very much for the information. I would have a question which might be silly, but I get confused on the period to use when analyzing a market. 1 day, 1 week, etc. What's your advice on this? My advice is you've got to figure it out for yourself, Benjamin. There is no hard and fast rule about this. You will understand that by taking a position of a longer period of time, you're exposed to risk for more period of time, and that may be difficult. You may not. Your sleep might be distracted. Your thinking might be distracted. Your life might be distracted. Being able to hold on to a position over a longer period of time requires a certain focus, requires a certain fortitude that you may want to develop over time. So starting out on shorter length trades may be better. But there's no one way is not more profitable or more risky than the other. Line of gold versus Forex, stocks versus indices, which to choose to diversify well. You have to do your homework, Lionel. I can't tell you. You have to do your homework. There aren't too many rules in this business. Those are the kinds of things you have to find out for yourself. I personally trade the S&P 500 and crude, my two favorite assets, but I trade Forex. These days I've been trading a lot of commodities because the war in Europe has totally fucked up the economy, the commodities markets, wheat, corn, crude, natural gas, palladium, you name it. So you have to roll with the punches. Thank you, Eduardo. Thank you for the compliment. Very good presentation. Do you usually use ATR, or is there another volatility indicator? I don't usually use ATR. I only use it for the point of showing that there is a volatility indicator. I use the graph itself. One of the reasons I adhere to the less is more rule, Eduardo, is that all indicators are based on the 5 things that are on every graph: open, high, low, close, and the volume during that interval. And most markets output that data for every time interval. All indicators are some variant, some combination of those data points. You should be able to, over time, simply see the volatility with your naked eye. We as humans are innately powerful pattern recognizers from youth. We're pattern recognizers. We're able to, they say that the average child between 1 year and 3 years old is able to distinguish between a friendly or a dangerous face simply by seeing the patterns in their face. An average intelligence child. So we should, that's how I do it. That's my short answer, Eduardo. Mike asks, please can you us with the use of the charts how to calculate stop with ATR? I sort of did that, Mike. Mike, I can't. I don't want to really run through that again now, but it's a percentage of the account. You decide how much you're willing to lose. Let's say the percentage indicates that you place $1,000 on the trade. You have a $200,000 account, and you place 2%, so that's $2,000. Oh, sorry, 100,000, whatever. You get my ad. $1,000 on the trade. How much are you prepared to lose? This is something that's a highly personal fact based on your risk appetite. There is no standard. There is no rule. If you're the person that can take risk and swallow it and even embrace it, then you would probably have a much higher, a wider stop loss than someone who doesn't. I'm more conservative. I don't like loss. I don't like to lose. I have a conservative stop loss approach. I am prepared to make less money but lose less money. Highly personal. It's individual. Great, Sabusi. So always a pleasure to have you in the room. So, ladies and gentlemen, that pretty much concludes all the questions that were asked. I'm going to bring the session to a close and state that on behalf of the staff and the management here at Alvexo, I'm your host, Seth Julian, wishing you all, ladies and gentlemen, I wish you all the ability to trade with confidence. Bye-bye for now. My pleasure, Thomas. We all have lost in the markets over the years. My pleasure, Joyful. Thank you for joining us. Thank you all for your comments. It really makes the subject much more interesting to all of us, myself in particular. Don't worry, Thomas. We've all lost it. The question is, can you arrest those losses and overcome them? And that was what I hope we could contribute to a little bit tonight. My pleasure, Mimi. Thank you for joining us. Always good to have you, Joyful, in the room. All right, ladies and gentlemen. Bye-bye for now.